I just asked a question. What currency do you get out of? Sorry, do you go into? Well, I mean, there's only one answer for that, and that is that as a foreign investor, foreign holder, whatever, of say US assets or British assets or whatever, you go back to your own currency, because that for you is your risk-free position, because you account in your own currency, if you see what I mean. The only other thing is that the value of these currencies will be reflected in their exchange rate with real legal money, which is only gold. Silver maybe as well, but particularly gold. And I think that what we've seen is we have seen the banks, the big investment banks, actually realize this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold. Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up. I mean, they don't produce forecasts like, we think it's going to go to $10,000. They don't say things like that. I mean, don't accept any forecast as being the truth, if you like, in terms of what the forecaster actually thinks.
Gold and silver are increasingly acting as the true benchmarks of value, exposing the steady erosion in fiat currencies rather than reflecting intrinsic volatility themselves. Large financial institutions appear to recognize this shift, quietly positioning for higher gold prices even if their public forecasts remain conservative. At the same time, a sharp decline in open interest in futures markets signals a broader move away from paper contracts toward physical metal, highlighting underlying stress in the system, particularly in silver, where supply constraints are more acute. Meanwhile, practices such as gold leasing in Western markets create distortions like double counting, masking the true availability of physical gold and reinforcing the disconnect between paper representations and tangible supply. Alasdair Macleod argues that this evolving dynamic reflects a deeper structural transition. As confidence in fiat systems declines, gold is reasserting itself as the ultimate form of money. He emphasizes that falling open interest on exchanges like COMEX is evidence of participants exiting leveraged, paper-based exposure in favor of physical ownership, a trend that could strain the system further, especially in silver markets where shortages are more pronounced. He also points out that Western accounting practices, particularly gold leasing, obscure reality by allowing the same gold to be recorded multiple times, unlike more transparent approaches seen elsewhere. In his view, strong and persistent demand from countries like China, combined with limited physical supply, underscores that the upward pressure on gold is less about speculative enthusiasm and more about a gradual but decisive shift away from fiat currencies toward hard assets. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
The only other thing is that the value of these currencies will be reflected in their exchange rate with real legal money, which is only gold. Silver maybe as well, but particularly gold. And I think that what we've seen is we have seen the banks, the big investment banks, actually realize this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold. Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up. I mean, they don't produce forecasts like, we think it's going to go to $10,000. They don't say things like that. I mean, don't accept any forecast as being the truth, if you like, in terms of what the forecaster actually thinks. But the fact that all these banks, and indeed at the last LBMA meeting, I think it was in Korea, in October-ish, September, I can't remember. Anyway, last year, again, the consensus was for higher gold prices. The establishment knows that the gold price is going up. They don't necessarily understand that it's because the dollar is going down and gold is relatively stable. It's the dollar that's going down. It's other currencies going down. but they know in which direction this is going. And so what we've seen on COMEX is we have seen open interest in gold fall, and it's fallen to the lowest level for over 15 years. It's something like 390, no, 300, I think it's got down to 368,000 contracts. This is the lowest level for 15 years. Silver is already at the lowest level in terms of open interest on COMEX, the lowest level for over 20 years. In other words, this is the system getting out of paper. Silver is a huge, great problem because everybody's short of the stuff and they can't really get out of it, say. Gold, in theory anyway, is slightly less of a problem because while they're short on COMEX, they're long in London. At least that's always the assumption. And I think that was probably the assumption. I think that's probably true when, the LBMA's straw poll came up with forecasts, above the then price. In other words, everybody was basically net long across the market. But China is sucking gold out of the world. It really is. I mean, the banks are finding huge retail demand, which is continuing, despite the markdown in prices. I mean, I think the markdown in prices was, if you like, some sort of combined attempt to try and really shake out the bullishness out of the system. But China is a huge, huge saver. I mean, basically, I don't see that. I don't see that Dubai, Abu Dhabi, wherever, really been very much a storage center. What they are is a big market, yes. And stuff goes on to India in particular. So, excuse me, I think that's the way to look at it. You've got a lot of bears, gold bears rather than bulls, trying to sort of make up negative stories, saying, oh, they want to sell their gold because, they need the funds. I mean, what a load of rubbish. They've got dollars coming out of their ears. They've got plenty of dollars to sell. It just doesn't, so there is a small element, if you like, of, okay, you've got market disruption in physical gold. Of course you have. But which way is that going? It's not a slam dunk. I mean, do locals say, here's some dollars for some gold? Or do they say, here's some gold for some dollars? Well, the answer is they've already got dollars. They don't actually need to rush out and liquidate their real money in order to survive. I mean, there may be some in that position, but I think that's a tiny minority, really. There is a disruption, if you like, in the distribution of gold. Yeah, of course. I mean, how do you explain a currency which goes down all the time, and yet they continue to accumulate gold, or appear to continue to accumulate gold, and then suddenly they turn around and want to support the currency by selling gold? Come on, this is nonsense, complete nonsense. So, I mean, I thought that's the first thing. Don't be confused by this. Now, what we do in the West is, if, let us say, a central bank leases gold into the market, it records it still as its own gold. It doesn't record the leasing. But somebody else will record the leased gold as their own property, which, of course, it is in law. If you lease gold, it becomes your property during the duration of the lease. So you get double counting. You could almost say that the Turks they do it a bit differently, probably slightly more honestly than we do, in fact.
Gold's rise alongside a strengthening dollar during periods of global stress is not a contradiction, it reflects a deeper reality. The entire fiat currency system is losing purchasing power at the same time. When measured properly, it's not that gold is surging uncontrollably, but that currencies are steadily declining in real terms, with gold acting as a relatively stable benchmark. Short-term price drops, including sharp pullbacks from recent highs, are largely driven by paper market dynamics rather than any weakening in underlying demand. Physical buying, especially across Asia, remains persistent, steadily drawing bullion out of Western markets and tightening supply conditions beneath the surface. Alasdair Macleod explains that these sell-offs are best understood as strategic shakeouts, primarily in futures markets, where widening spreads and volatility push out leveraged speculators while allowing larger institutions to reposition. Major investment firms, managing vast portfolios with little exposure to physical gold, have an incentive to suppress prices temporarily to accumulate without being caught offside as the trend strengthens. Meanwhile, the broader investment landscape is shifting, with capital gradually rotating away from overextended sectors like tech and financials toward hard assets. Even if short-term liquidity shocks trigger brief moves into dollars, such reactions are unlikely to alter the bigger picture. Structural demand driven by institutional repositioning, persistent Eastern accumulation, and limited physical availability continues to build, suggesting that paper market fluctuations are largely noise against a tightening supply backdrop in both gold and silver. Let's get back to the interview.
Dollar trade weighted rising at a time of international credit and currency crisis, and find that the gold price is rising at the same time. Because what's happening is that the whole fiat currency complex is going down. It is losing purchasing power. Whereas, of course, gold doesn't lose its purchasing power. It fluctuates a bit, but not very much. And so the rate, if you like, of these currencies measured in gold appears to rise. Really, you should look at it the other way around. It's the currencies going down rather than gold going up. Well, I think the fall from, sort of very briefly, it got up to something like 5,500. I think it just touched it overnight or something. I think that was probably discounting things a little bit ahead of time. You get this. And so it was vulnerable, if you like, to a shakeout. But the interesting thing is that on the shakeout has been a paper shakeout, not a physical shakeout, because the retail demand, retail demand in the terms of, in Western markets has declined and probably sometimes have been net sellers, but in the Far East, demand has continued, and it's basically sucking bullion out from the West. That's continuing. And I think it's really, as I said earlier, there's this growing realization in investment banks and bullion banks and so on, that gold is going up. Quite why it's going up is something which perhaps they don't really understand, but nevertheless, they want to position themselves so they don't get caught. And I think it's as simple as that. And the best evidence of this is the massive decline in open interest in the futures markets. The speculators have been discouraged from playing, particularly silver. If you look at silver, the way it works quite simply is you just widen the spread, and anyone trading on margins, the other thing, well, to hell with that, or go to do something else. And that's really what's been happening. They've been trying to square their books. Remember also that a lot of these big American investment banks who have been calling gold higher, they manage huge amounts of money. They've got discretionary management powers over trillions of dollars. And their customers don't have any gold. They haven't bought gold for these customers. They might have bought a few gold mines as part of sort of portfolio mix, whatever. But they haven't got physical gold. So they need to get the gold down. They need to get into a situation where they can improve the position of those portfolios, particularly since those portfolios are very, very heavily angled towards industrial and tech stocks, and also financial stocks, which are basically beginning to underperform. So you can see there's a huge, great shift going on, if you like, in the entire investment management industry. They needed to get the gold price down because they didn't want to get caught. It's as simple as that. And I think that's probably over now. It's close to. That could be. If we get a shock overnight, we could have this situation where, the gut reaction, the Keynesian reaction is to go for immediate liquidity. Like, we're going to buy dollars. We've got to buy dollars. We've got to sell this, buy dollars. That could happen. I wouldn't rule that out. In which case, there might be another move down in gold and silver. But who cares? I mean, you're not looking at the big picture. There is absolutely, there is a disincentive, if you like, for the large Chinese banks to take gold out of those vaults. So they will back their gold accumulation plans by holding physical gold in the vaults. I don't know whether they run a completely covered position. Probably not. I don't know. In other words, there might be an element, if you like, of unallocated, like it doesn't exist, backing these vaults. I mean, obviously it's unallocated because, there's a huge lump of gold in the vault here, backing accounts here. But we don't know that they're 100% backed. But you can see that there is a squeeze developing through, if you like, household demand, nothing else. And I think what goes on in futures markets and all the rest is just noise. It really is. Just think, $5 to $6 trillion equivalent. Got to find a home. And where else does it go? And that's why you've got to drift. I mean, gold is, you want gold in size, forget it. You're not going to get it. It's all gone. It's all sort of pre-demanded. You've joined the queue. And the same is true in silver. That's been happening as well. And again, we're talking about, in the case of silver and gold, but it's probably more pertinent in silver in a sense.
Gold and silver are steadily reasserting their role as anchors of real value in a system where fiat currencies are losing purchasing power simultaneously, even when short-term moves suggest otherwise. Price volatility and periodic sell-offs are largely driven by paper market mechanics, positioning shifts, and liquidity events rather than any deterioration in physical demand, which remains strong particularly across Asia. The ongoing decline in futures market participation, persistent physical accumulation, and tightening supply conditions point to a structural transition already underway, where institutional capital is gradually repositioning and available metal becomes increasingly scarce. In this context, short-term fluctuations matter far less than the broader trend, a continued shift away from paper claims toward tangible assets, with gold and silver benefiting from both monetary instability and constrained supply. How will a sustained move from paper gold and silver to physical ownership affect price discovery and financial system stability? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and we hope you enjoy the video.